What's going on, everyone? Welcome back to another episode of Fear-Free Passive Investing. My name is Lucas Miller, host of this show where we talk about all things related to passive commercial real estate investing. We've got an awesome show today. I have on the show my good friend, Ben Lapidus. Now, if you don't know, Ben is the Director of Acquisitions for Spartan Investment Group based here in Colorado. Ben's highly skilled at asset management and financial analysis and has helped launch and grow Spartan's portfolio of really unique properties. We're going to hear about some of the different asset classes that they're in. But Ben, before even joining Spartan Investment Group, had 24 successful real estate investing deals. So he's definitely got a lot of knowledge and a lot of advice to offer. But he's also the founder of the best ever real estate investing conference. If you haven't been, it's huge. It's awesome. You got to be there next year. It's a great place for passive investors to network and learn and maybe meet some active investors if you're looking for deals. Now, I'm thrilled to jump in and hear about his advice. But first, I want to remind everyone that we have tons of great resources at fearfreepassive.com. If you're interested in passive investing at all, you got to head over there and check it out. That's fearfreepassive.com. And with that, let's jump in and hear from Ben. All right, Ben, thanks so much for being here. I'm really excited for this interview. It's wish we could have been doing this in person, actually, but because of Corona, we can't. But yeah, for those who don't know about you, why don't you just take 30 seconds or so and talk about how you got to this point.
Yeah, sure. Lucas, thanks for having me on, man. Director of Finance and Acquisitions for Spartan Investment Group. We're a self-storage development and syndication company. Also the host of the Best Ever Conference, a real estate investing conference for new generation syndicators in all asset classes, held in Denver once a year. I did the Wall Street thing for a hot minute back in the last crash. Didn't like it, so I fled to Costa Rica and started a renewable energy study abroad company for 3 years. Grew it to about 500 clients a year at $4,000 a piece, just shy of about $2 million revenue a year. Sold out of that, used the proceeds to get into real estate investing, while I also got into the ad tech industry in New York City. The first company I worked with IPO'd. The second company I worked with got acquired for hundreds of millions. Made a lot of the VPs around me some money. They heard I was buying real estate in cheaper markets than New York City. So they started throwing cash at me completely unsolicited. And that's how I stumbled into very terrible syndicating practices, most of which went just fine. Others of which I'm glad I exited when I did, because they would not have ended well. But really enjoyed the process. And so when I moved out to Denver in 2016, I got formalized and spent a lot of time really honing in on what I wanted to do. Joined up with a pair of now buddies, I'll call them, who are partners. And we focus all of our attention on acquiring a self-storage empire.
That's awesome. So you touched on a lot of stuff, but I definitely want to talk about the bad practices here. Now, I assume I know what you're talking about, but for those who might not know, what did you mean by that? Because you obviously weren't, doing bad things, but I guess we have to say that you were doing bad things, I'm guessing, but you weren't maliciously about it.
Yeah, no, right. So it's like one of those things, like it's somebody hands you a car and says, okay, you're allowed to drive, and you've never driven a car, you've never taken a test, you've never read any signs before, and you just start driving on the highway and somebody pulls you over and says, do you know how fast you were going? Yeah, 78 miles an hour. Do you know what the speed limit is? And you say, what's a speed limit? It's kind of the equivalent of that. So, obviously nothing malicious as soon as you find out that it should be done a certain way and you ask why, and you're told this is the reason why. And you're like, oh, that makes sense. That's actually really good protection for my essentially my customer base, my friends and family who participate in these offerings. I would love to follow suit on that because it is in line with the values of transparency and integrity that the firm lives by. But I guess at the time that I lived by, not the firm, it was just me. So some of those bad practices were just taking people's money and throwing them into illiquid assets, not going through a security process, not offering any disclosures on the risks. We would have conversations, but nothing formal, nothing filed with the SEC. The majority of what I did was just fine. There's a provision under the SEC code called 4 Alpha, which basically says I think it's literally 2 lines. It's one sentence, and it says at the end of the day, you could also just do whatever you want. But I think it's case law suggests that that's for 5 investors or less. And most of what I was doing at the time was 5 investors or less. Then I syndicated my first multifamily, which was terrible for a variety of reasons. But it was more than 5 investors, and I did not disclose anything. I did not file with the SEC. I made verbal disclosures. I did my best effort to disclose what I thought would happen. And I just didn't go through the appropriate processes. And so I've since learned what to do to be in a position to protect myself as well as the investors.
Yeah. So this is really good. I'm glad you touched on this because the laws surrounding securities law is really complex. And I would say the majority of sponsors have probably done something wrong at some point just because the rules are very gray in some areas and also very black and white in other areas. Like you can either be violating something outright and not know it or be in this weird gray area. And really, it's difficult to navigate. So I'm glad to hear you say that. But as a passive investor, what steps do you think you could go through to make sure that your sponsor is doing things right? Like, obviously, as a passive investor, you're not going to have a whole lot on the hook other than, obviously your principal investment. But, you're not going to be sued by the SEC probably because your sponsor did something wrong. But how can you make sure that they're doing the right thing?
Yeah. So I think that a lot of it comes down to little small tests, because the reality is that let's say that the sponsor is malicious, is nefarious, and is about to lose a whole bunch of your money. They're probably not going to lose as much money as the SEC will if they step in. I actually have, I'll call him an acquaintance, somebody that raised a lot of money way too fast back in 2010, 2011 in California, and did all of the worst things. I mean, he was providing return statements that included appreciation without any market assessments being done on his real estate. And he was cashing people out. He was treating it like a liquid investment. And so folks were getting the returns, including the appreciation, when that appreciation wasn't actually captured. So somebody alerted the SEC. SEC steps in. They hire a bunch of trust attorneys, and the trust attorneys end up taking like 30 or 40 cents on the dollar of the value, plus the losses because they didn't manage the real estate as well as a real estate manager would. So that's an additional 20 or 30 cents. Investors got 30 cents back on the dollar of the original principal.
Oh, man.
If the bad actor, who was in fact a bad actor, don't get me wrong, had just continued his work, I think worst case scenario, investors would have gotten 70 or 80 cents back on the dollar. So yes, the SEC is there to protect you. But also when the SEC gets involved on that particular investment, you might end up in a worse position than if the SEC weren't involved. So what can you do to protect yourself with all of that in mind? Run them through tests, ask questions, and just see where they've been. So we have one investor that says, I like to do things like this. And he gives us a list of 30 different things in the operating agreement, the PPM, that he asks us to do. And we say no to 24 of them, let's say. On 6 of them, we make a change, and we only make the change if we think it's good for all of our investors, not just that one particular individual. And we say, you know what, this is actually a great protection that we'd love to include, not just for this investment, but for the future ones. The other 24, we're declining, and here's the reason why. And here is your risks as a result. And here is our gain or our reasoning, like why, to decline this ask. So this particular investor says, you know what, that's fine. I asked you for these 30 things, not necessarily because I wanted all of them, just to see how you would respond and how you'd act. Because he has gone through that same process before, and that list of 30 items, he might have a sponsor that says, I don't even know what 25 of these mean because I haven't read my own operating agreement and I haven't read my own PPM. Yeah. So that's the kind of test that you're looking for.
Interesting. Wow, that's really good to know about the SEC. I didn't know that they would necessarily take the losses as well. That's devastating, I'm sure, to a deal. But yeah, that's important to know that the SEC can get involved, and they probably will get involved if you're doing stuff nefariously. But most of the time, it's just harmless mistakes, and it's a slap on the wrist, but hopefully won't get your money back. So I want to go back real quick to talk about, you mentioned at the very beginning, people were throwing money at you. You left your job, people were throwing money at you. How did you cultivate that trust with them to literally have them money thrown at you for real estate deals, obviously?
Yeah. So the first time it was by accident. I worked at a company it was one of the first unicorns. When you hear about unicorns, it's a buzzword now, but back in 2012, 2013, there was maybe a dozen unicorns. And the company that I worked with was a tech company from the Bay Area that was like the third one that had ever reached a private valuation of over $1 billion. And a VP of the department that led my youthful self. I was in a position where I was going through the exit of my company a year after I had left. I was exiting my financial position with the company and transitioning into real estate. And I confided in him because I knew that he was an entrepreneur before he started his career out in tech. And so we got to talking about the real estate and what I was doing. And I never asked for money. That sage old advice of when you want money, ask for wisdom. When you want wisdom, ask for money. I was kind of doing that by accident with him. I was asking for wisdom, and he knew that I was a smart guy just from the work that I was doing for him. And I think he knew that I wouldn't last forever there. I only lasted 2 years because I got bored. But he wanted to maybe build a relationship long term. So he said, "What are you buying? I want to buy, I will give you all of the money for what you are buying." And so he gave me 125 grand. I went and I bought 3 houses with it. And to this day, it's still generating, I think, a 16% cash on cash return, 23% yearly return with principal reduction.
Wow.
It's on a 15-year mortgage. So he's very happy with all that stuff. I'm very happy with all that stuff. And then from there, he was a nucleus of this 1,200 person company. And people were like, "Hey, did you just invest with that smart guy who's like the youngest person in the office?" You're like, "Yeah." And then people would ask me about it, and I'd be all mysterious, and then they would just ask me more questions. And so people were kind of, it was like $50,000 chunks to get a 15 to 20% cash on cash return, or a $250,000 chunk to get like a 6% cash on cash return in New York City, which is where I was based at the time. People were really, really interested in the $50,000 chunks for a 15+% cash on cash return at the time. Back in 2012, 13.
Yeah, that's really cool. So take us through how you moved from single family homes to now building the self-storage empire, like you said.
Well, I got squeezed out of single family homes real fast because I had no systems, processes, or investing strategy. I was definitely just riding the cheapness of the time. Back in 2012, you could buy a 4-bedroom, 2-bath house in a decent neighborhood in a suburb of Richmond, Virginia, where I started my investing career, for $80,000, $100,000. You could dump $10,000, $20,000, $25,000 into improvements, and you were ready to go to rent it out for $1,200 a month. I mean, it was so cheap that I was able to get these things cash flowing with double-digit returns on 15-year mortgages, which is hard. It's impossible to do now. It's hard to get double-digit returns on 30-year mortgages now. So, I mean, at the time, it was just stupid. And I ended up picking up 13, 14, 15 houses like that. And I got the houses have doubled in value, which is great for the portfolio I built, but impossible to keep buying and still hit the same returns. So I started looking at other cities. I put my toe in the water in Rochester, New York, picked up 4 properties there. But I really didn't like the risk associated with those properties. And I didn't like the travel that I had to get to for Rochester when I moved out from the Eastern Seaboard. It just became so difficult. So many people. Bigger Pockets has added a lot of amazing transparency, but the downside of that is so many people have flooded in and have been buying up real estate. So I transitioned into commercial, made an error in judgment in my buying. I bought with way too much per door for what I was buying. I am a terrible operator by myself. So I knew I wanted to get to commercial, but I also knew that I didn't want to do it on my own because I'm a great negotiator, great underwriter. I love getting the art of the deal together. I like doing feasibility. And then the deal closes and I'm a dog chasing squirrels. I like shiny objects. I want to move on to the next one.
Yeah.
So I knew that commercial needed to be with scale, and that scale required more people. So I partnered up with 2 other gents, and we've been building a company in storage for the last 3 years. Does that answer your question, or was that?
Yeah. No, this is good. So I want to drill down also on how you moved from the single family to the asset class, I should say. You tried multifamily, it didn't go well. Now, why self-storage? What do you see there that other people aren't seeing, or you're doing better, obviously, than a lot of people? What do you like about that asset class?
Well, we went through, so my partner, Scott, he he was an information warfare officer, and he was trained heavily on the military decision-making process. So he brought a lot of that education and thinking protocols into our company. And we went through that decision-making process and evaluated every asset class, came up with criteria that matched our desired investing kind of strategy, I guess. And those evaluation criteria boil down to easy to maintain, easy to manage, and easy to monetize, evict. So by easy to maintain, we mean not too much below the ground risk. With multifamily, you've got tons of plumbing under the earth. With storage, you've got a concrete slab and then stuff above it. Mm-hmm. By easy to manage, we mean not too many phone calls. We don't want the toilet calls. A self-storage facility that could have 1,100 units and one toilet. So that's a nice plus. And then the easy to monetize, well, there's not the same kind of tenant laws in storage as there is in multifamily. So you have depending on the state, anywhere from a 15 to 60 day period to get folks out. And the 60 days is really just for boat storage in certain states. Usually within 30 days, you can start that process. There's no foreclosure process. You just have to advertise that you are auctioning off a unit, and then you can auction off a unit and you're good to go. So, and the kind of the moral downside of auctioning off a unit doesn't feel like we're affecting the livelihood of folks as much as an eviction process might in times like right now.
Yeah, that's the reason they've stopped evictions on multifamily properties. That's a very good point.
In storage during the pandemic.
Yeah, I like that. Take us through your process for bringing in and onboarding a new investor. We talked a little bit about the PPM earlier, but bring us through, like, if I know nothing about self-storage, but I trust you, I like you, I want to invest with you, we have a pre-existing relationship, I like you, take me through that process of how you would onboard someone to get them comfortable with this idea.
Yeah, so to date, the majority of our raises have been under 506 Bravo, 506B, meaning that we do require a previous existing relationship. We are looking at doing our first Charlie offering, 506C, which means you would need to be an accredited investor, and we are able to do open solicitation. But so far, the folks that we've worked with haven't always needed to be accredited investors. So we might have a conversation like this, Lucas, and somebody would hear about it. They go to our website, they fill out a form, or they email me directly. And we set up a call, and we just have an introductory conversation where people ask more about storage. We tell them why we like it, why we invest in it, some of our example assets that we've done in the past. And the most of our time in that conversation is focused on them, what their life is about, what their personal goals are, their investing goals are, what they're comfortable with as a risk structure. We don't have a one-size-fits-all project type. We have a ground-up development, and we also have a stabilized portfolio. We have stuff that cash flows 7% in year one, and we have stuff that doesn't cash flow until year 5. So we know that not every deal is going to be for every investor, and we like to try and identify who might be a good fit for certain things so that we can offer our guidance on what may or may not work. We've never really had an issue where we've had to go shake the trees. We've always had enough resources at our disposal for the deal flow that we've had. So we like to offer guidance and say, hey, this might not be the best deal for you. You told me this in the past. I know you're expressing interest in this deal, but maybe this one isn't right for you. And that's better for us, because if you're uncomfortable after you do the deal, you start asking us a bunch of questions and sending us a bunch of texts, that distracts us from doing a good job managing the assets. Yep. So we don't want to be distracted. We want to make sure that whenever we're having conversations with you, it's when we're like taking our time to have beers, not in the middle of the workday. So that's the first step. We get to know a little bit about you. And then we still have a couple more touch points. We hope that you hop on one of our webinars to learn about 401ks. We hope that you're available when we hit up your city and we're able to travel. We do happy hours in different cities. And we're always flying around to different conferences and doing one-on-one stuff. We hope to meet you in person somewhere. So we look for a variety of touch points, and we hope to let 60 days pass if we haven't had an in-person meeting before we start sending you opportunities. And then when I say send opportunities, we send out a quarterly newsletter, and we also send out an an announcement that we have a deal under contract and that a webinar is going to be coming soon. You sign up for the webinar, you may reach out and say, this looks really interesting to me. Can you please send me some more information? Or you can go to our website and download that information in our deal room. You take a look at it, you ask us questions, you review the operating agreement, the PPM, and if you're interested, you fill out a subscription, a purchaser questionnaire, followed by a subscription agreement if you qualify as an accredited investor, and then you would sign the final paperwork and have your investment filed.
I like that. Yeah, I mean, I would imagine that self-storage is probably not a lot of people's like first investment in commercial real estate, passive investment. Has that been your case, or do you have a lot of first timers?
I have the benefit of being able to focus on what I do best, which is acquisitions and corporate finance. And my partner, Ryan, does the majority of our investor relations conversations. But I'd say it's a mix. When we did first get started, we had a pretty sizable personal network, and people who were investing with us were investing with us because of us, not because of our assets. And I'd still say that's probably the case today, that our folks are investing with us because of us as individuals. Less so about the asset class or even the particular investment opportunity. So a good number of folks actually are investing in our investments as their first syndication, their first private placement.
Yeah, that's awesome.
Yeah, I probably more than 50%.
Oh, very cool. I like that. Let's move it over to acquisitions and talk about what should passive investors be looking for if they're evaluating a self-storage deal? Like, what are some high points that you can easily maybe take 10 minutes or so and just say, no, that's off because it doesn't meet this? Like, what do you like to see?
Yeah, the biggest thing in storage right now is over construction. So there's been a ton of supply. More supply has entered the market in the last 5 years than the previous 30 years combined. So there's been a huge boom. The cat's out of the bag. Everybody knows that storage is awesome. And by consequence of there being so much new supply, rent growths have diminished over time heavily. So there was a time when 6 to 8% annual rent growth assumption was backed by historical data, and that wasn't absolutely absurd. People who are still using 6 to 8% rent growth assumptions are out of their effing minds. People who are using 3 to 4% rent growth assumptions are out of their effing minds.
Yeah.
We start off our default value for rent growth assumption when we load a new underwriting file is 0.75% annually, and that doesn't start until month 25, year 3. So we assume zero rent growth, not on our actual rents, but on market rents for 2 years. I think that's the biggest thing that folks need to be careful of is when they see an underwriting file that's got 3-4% rent growth, they better ask for some data that supports how that could be feasible. Even the REITs who are the optimal operators, their Q1 announcement for 2020 has slowed down to 2.1% on average rent growth for Q1 of 2020. There's 5 REITs, publicly traded storage REITs, that are out there. And their rent growth has slowed down substantially in the last couple of years. So all of our investments have some type of value added component. We are not trying to carry the wave of just the storage asset class, just growing on its own. So that's number one, is look for rent growth. Yeah.
Well, and I want to make a quick clarification, because if you're brand new listening to this and you hear I'm not underwriting any new rent growth, there's a difference between what you were saying, market rent growth, and the value add rent growth. Like if you buy a self-storage that's $300 under market rent, of course you're going to raise those up to market rent, but you're not underwriting market rent growth or like what everybody else is willing to pay.
Yeah, that's exactly right.
Okay, good. Right. Okay, so next point. I like that. Sorry to interrupt.
No, you're good. Yeah. I'd say cap rates as well. Cap rates can be all over the place, but they follow a pretty good pattern. If you're finding something that is over 8%, there's a good question to ask why. Like, why is this thing actually 8%? Either what are you doing wrong with the underwriting, or what is so wrong about this asset that it could sell at 8%? And maybe there's nothing. Maybe it's just an awesome deal. And if you're looking at disposition, the terminal value, meaning like the end point when we go to sell this asset in 5, 6, 7 years, whatever the hold is, and you're assuming a 4, 4.5, 5, 5.5 cap rate, it's not the same as multifamily. You can't take the cap rates from multifamily and translate them into storage. And that's because the lending environment is completely different. There's no agency lending in storage. So the rates are higher. The spreads have been pretty consistent over the last 4 or 5 years between interest rates and cap rates, so they haven't moved too much. If you're looking at literature from a year or two ago, it probably holds today.
Interesting. Very interesting. This is really helpful, and I feel like I have a million questions, but we're low on time. But I want to get to a really big question. And how can someone, as a passive investor, maybe not quickly, but identify if their sponsor is someone who's trustworthy or not? Like, this is a question I ask everyone, and there never seems to be the same result. Like, you ask someone their favorite real estate investing book, chances are it's probably going to be like Rich Dad, Poor Dad. I ask, how do you tell if your sponsor is trustworthy? I get tons of different answers. So I'd love to hear yours.
Interesting. Well, I'm curious what you think about this answer, because not everybody would qualify right out of the gate. But what did your sponsor do when he or she lost money, or they lost money? I think that's probably the most telling sign. If they haven't lost money, either they're amazing or they haven't been around the block too much. And if they have lost money, what did they do? And don't get me wrong, there's definitely the operators out there that have a 10 plus year history and haven't lost any money. I've lost money. I'm pretty sure didn't we were together talking about how we both lost money at the Best Ever Conference, right?
Yeah, right. That was how we introduced ourselves. I was telling you about how I lost money. So that's funny.
Honestly, it's not that I want my sponsor to have lost money, but that if they have, I'd love to know what they did.
Yeah.
If they haven't lost money, what did they do when they didn't hit their return metrics, or they didn't hit their time frame? Why? Mm-hmm. What's the story? Was it as a result of the market, or was it a result of their operations? If it was a result of their operations, what did they do to rectify it? If it was a result of the market, did they fold and give like all of their margin away to their investors? Because I don't like that either. I don't want my sponsor necessarily giving away a whole bunch of money to the investors when it's a market condition that messed up the deal. Because if they're not making money, they're not going to be incentivized to do a great job. So,
that's critical. I think that's really smart. You don't want to lose money. Obviously, it sucks when you lose money. But what I like to tell people is I use that opportunity to then transition that into, how can I not do this again in the future? And how can I learn from other people who have lost money in real estate, and how I can implement that system into my business and be better as a result.
Yeah. And I think also looking at the capital call provision in a PPM, that would be another way to kind of do the same kind of test. That's not how did you lose money in the past, but what would you do if you needed more money in the future because things weren't going so well? For example, we just had a tornado rip through one of our parks.
Oh, shoot.
And completely just shut it down. We went from 99% occupancy to 0. And we needed to lay out a few $100,000, and the insurance check is going to take a little bit of time to get to us. We could have done a capital call, but we just took, A, we got that park back up and running in 5 days, which was awesome. B, we got back up to 70% occupancy in 6 weeks. And C, when we needed to cover down on costs, it came out of our corporate cash balance. We had the resources, and we felt like that was the right move. And we got some good feedback on that outcome. So things like that.
Well, that's okay. So that brings up a lot of questions. Like, what can investors look at in a capital call? Like, what should they see? Obviously, I always say on the show, like, you want to see a capital call provision because it shows forward thinking. So what does your capital call look like? Yeah.
So we reserve the right to convert 5 shares at $50,000 a share, convert basically $250,000 of our equity into more shares. What that does is that says we are going to go sell our securities, our equity.
Interesting.
We ask you for more money so that we don't have to ask you for more money. The downside of that, of course, is if there's a preferred return, now the same amount of returns are going to be split around across more people. So your return's going to be reduced a little bit, not a huge amount, but a little bit. But we don't have to do a capital call. And obviously Spartan loses out on a lot more because that's $250,000 of equity that we're not getting the upside on the back end. So we'd rather take it out of our side before we have to, go do a capital call. But we also don't want to use too much of our working capital every time something goes, a little bit wrong, because we need that to continue to find more deals, and which will help make more money for our investors. So that's a good kind of middle ground. That's our first step. We also have a provision in there that allows us to loan money to the company at the IRS allowed minimum, which I think right now is 1.5%. Last quarter it was 1.7%. So on occasion, we do loan money to our subsidiaries, but it's at a ridiculously low interest rate. Would be lower if the IRS let it be lower.
Mm-hmm.
Yeah.
Wow. That's interesting. I've never really heard of that. Selling your own shares. Like I like that. It shows that you're committed to the deal. It shows that you're definitely a partner in the deal. You're not just there for the fees. You're not there for the money. So that's great. But I feel like we could talk for another couple hours, but I definitely want to wrap up with our final question. And that is, what advice would you give to someone who's interested in passively investing, but they're fearful of taking that first step?
So I would do a quick calculation first to see what would it look like if you lost all of your money. Because regardless of the investment that you're making, if it's in the stock market, if it's in a private placement, if it's in a startup company that your brother or your sister is starting, what would your life look like if you lost all of that money? How does that reduce your runway for your personal life? How does that reduce your ability to kind of save yourself if something happens, like you crash a car or whatever? So if there is pain by not having access to that money, I don't want your money.
Mm-hmm.
I don't care if you want to give it to me. I don't want it. I mean, we've got some folks who aren't accredited investors who have reached out and said, I need liquidity. I know that I'm not supposed to be able to have it, but I need it. And I feel for them,
mm-hmm.
but I can't endanger the investment on behalf of the other investors by breaking the code of our operating agreement and providing that liquidity to them. And we don't even have the means for that. So I would look at your personal situation and say, okay, $50,000, how much runway is that? How much money will I have left over in the bank? If it does not cause pain or anxiety, I think you're ready to invest. If it causes some pain or anxiety, think about what do you need to get to, either in a reduction of your expenses or an increase in your cash basis before you feel comfortable. And if it scares the shit out of you because of what life would look like without it, then you absolutely should not be making that investment. I don't want your money to begin with.
Yeah. Good point. I think I probably fell into that wrong category when I did my first passive investment. I was like, I can't lose this money. I need it. But luckily it worked out for me. But I definitely agree with you. I don't recommend that to anyone, and you shouldn't do that. But Ben, I really appreciate you coming on. This has been awesome. Definitely one of the more unique shows. If people have questions or they want to maybe find out a little bit more about Spartan or self-storage, where can they reach out to you?
Yeah, Ben at Spartan-investors.com. And that's our website. If you want to find out more about storage, Spartan-investors.com.
Yeah. And I'm sure if you're local to Colorado, which I know a few of us are, but if you are, I'm sure you could come to a happy hour sometime or go to your office soon. Hopefully,
yes,
if we open up soon.
My wife is a biomedical engineer, so she is on the more conservative side with this pandemic. But as soon as I'm permitted,
of course. Yeah, I like that.
I will be there.
Cool. Well, thanks, Ben. I appreciate it.
Cool. Thanks, Lucas.
See ya.
Thanks for having me.